Welcome back to the channel, guys. I want to do a quarterly update on the LNG Global Quality Dividends UCITS ETF. There's a couple of reasons for this. The first one is I know a lot of people invested in that one when it first came out. The second is I've used it in both the trading 212 pies that I've created. So I want to go into kind of the rationale of this fund and see how it's actually performing. I will do monthly pie updates as well as part of that, part of a series, but I did want to kind of dig into how it's actually doing, how it's performing, and I will revisit some elements of the fund because I think it's important for those of you that may be watching this for the first time. So if we look at the benchmark, it's the FTSE Developed All Cap Dividend Growth with Quality. The fund has accumulated 182.9 million, and we'll talk about the fact that it's actually got two versions of the fund. There are 959 constituents within the fund. It has a very low expense ratio of 0.29%. It is a monthly distributor if you get the distributing version, and it is a physical representation of the funds within it. If we look at the aim and a snapshot of it, the investment objective of the fund is to provide exposure to companies with higher than average dividend and quality characteristics in developed market countries. It invests in a basket of stocks aiming to provide quality income with quality screens and responsible exclusions. The strategy seeks companies distributing income consistently with the potential to sustain their payouts while screening out stocks with fundamentally poor balance sheets, income statements, and or ESG characteristics. So talking about characteristics, the fund promotes a range of ESG characteristics which are met by tracking the index and applying rigorous exclusions. Now, the base currency is USD. It's domiciled in Ireland. Its launch date for the accumulating was actually 18th of November 2025. The launch date of the distributing was 15th of January 2026. So we're going to look at the data as of 14th of May 2026. Okay, I just want to talk about the deep value multiples and a comparative analysis. So I want to evaluate the value tilt against the benchmarks, peer categories, and the broad MSCI World Index, which I tend to talk about a lot on my channel. So the first one is the price to earnings, so often referred to the PE. And you'll hear this a lot, which basically measures the current share price relative to the per share profits. And it's often a very key indicator that a lot of investors use very early on as their initial screening or initial filter. So the fund's low 13.55x PE highlights a strict value discipline, standing in stark contrast to the speculative high multiple euphoria typically found in unscreened things like the MSCI World Index, which is 21.4x. If we then look at the price to book, this compares market cap against the accounting value of tangible assets. So in short, a deeply compressed 1.72 price to book versus a 3.10 MSCI World acts as a structural margin of safety and a profound downside buffer during market contractions. And then if we look at the next measure, which is price to sales, now this values the company against top line revenue, which is highly resistant to accounting manipulation. So paying only 1.17x for sales guarantees exposure to companies generating massive real world economic volume. And then we've got price to cash flow. And this is one that I really like, particularly for dividend companies and dividend paying companies. So crucially for dividend strategies, actual cash, not accounting profits, pay dividends. And a 8.28x ratio proves these underlying firms are generating immense free cash flow to comfortably sustain and grow these monthly distributions. So I think it's important to look at some of these value metrics due to how the fund ultimately is trying to focus on value and quality. And I just want to kind of show that it is doing that. And we've even seen how it's doing that against some other benchmarks out there. Okay, if we look at the top 10 holdings now, strict size and premium control. So unlike cap weighted funds that dominate by mega caps, this fund employs a mathematical equal weighting mechanism across all of the stocks. This actively prevents single stock concentration risk. The largest holding is merely 0.3% due to organic intra-period price drifts. We can see, however, that it does have a sector weighting towards financials. Now, that isn't uncommon. Financial sectors produce a lot of cash flow, and therefore they are typically more common dividend payers. They have certain rules and regulations that mean that they have to keep a certain balance sheet. So it's no great surprise that financials top the list at 31%. Industrials, again, are fairly common to have in the dividend space because, again, they're fairly good cash generators. They typically are companies where you're always going to need to buy something from them. And therefore, irrespective of what's happening in the markets, they're typically always generating cash flow. And the same goes for the utilities and materials and consumer staples and discretion. Where we see some of the other ones, we've got energy and healthcare. Of course, energy is always going to be there because we always need energy. However, I think it's slightly restricted due to kind of the ESG. What you will notice that's missing from here is things like defense, which are again fairly good cash generators during certain periods, but due to the ESG characteristics, that's not on the list. For me personally, the nice thing is infotech is not that large, and we can see it at 3.7. If we look at the geographical diversification, this is another really important point that I really like about this fund is that it is spread out globally. It is genuinely global. Most of these other indexes are very weighted to the US, almost 60%. This is half of that. This is almost 30%. Yes, there is still a heavy US weighting, and that's to be expected, but it's nice to see other countries on there like Japan, UK, Canada, France, Germany, etc. If we look at the 2026 macroeconomic tailwinds now, the first one being new interest rate regime. So structurally, higher baseline inflation and higher terminal rates fundamentally alter the landscape. And this regime massively boosts net interest margins for well-capitalized global tier one commercial banks, which comprises the portfolio's dominant financial allocation at 31.3%. Another aspect is AI infrastructure supercycles. So hyperscaler capital expenditures surged past $610 billion in 2026. The explosive exponential growth of data centers requires a staggering amount of physical build out, directly benefiting the industrials, the utility sectors held within the fund. And then finally, geopolitical fragmentation. So persistent geopolitical conflict, localized supply chain disruption, and the drive for self-reliance actively supports elevated cash flows for integrated energy and materials companies, insulating the portfolio from regional shocks. In terms of the global exchange coverage, it's very vast. There is, as I said, a distributing batch and an accumulating batch. And I've just put the tickers on screen. I won't read them all out. But again, there is a vast amount in terms of GBP, USD, and Euro coverage on various exchanges, and probably the most common exchanges out there. In terms of country registration, it's available across Europe, and it's also got good country exposure. So hopefully one of your countries is covered. In terms of the kind of the beta evolution, this isn't a traditional yield chaser. The value trap sort of which blindly selects highest absolute yields, it's not one of those. It doesn't look for distressed equity, so yield artificially elevated by the plummeting share price and the capital destruction, which is the perceived severe dividend cuts and bankruptcies. It's a quality paradigm, looks at yield, looks at ROE, looks at historical growth, looking for organic distribution, so those dividends funded by true free cash flow, and the downside buffer, the mathematical mitigation volatility in contractions. It is domiciled in Ireland, so the withholding tax is limited to 15%, and the current premium discount to NAV is 0.04%. So if we were to look at this from an algorithmic construction, it's top quarter yield. So it's filter universe for the top 25% of the highest expected 12-month forward dividend yields, which rejects purely buyback focused firms, which I think is really important. The 10-year beta regression, so requires verified positive historical dividend growth over a decade, measured via linear regression to accommodate macro shocks, such as the one in 2020. And then a positive quality ROE. So strict mandate for mathematical positive return on equity protects against firms funding payouts via unsustainable debt insurance. So obviously there is a strict seclusion. Weapons, thermal coal, UN compact violators, and mortgage REITs are all excluded. Equally weighted, all of the constituents forced to a 0.10% partial semi-annual rebalancing in March and September. And so if we look at the monthly mechanics and the performance, so its dividend yield currently is around 3.85%. I think the idea was the fund was meant to target around about 4%. So it's there or thereabouts what it's tracking. And don't forget, this is current yield, not yield on cost. So that's another really important factor to bear in mind. In terms of the fund's performance, as of the 14th of May, the fund's NAV has done 10.4% year to date. Target index has been 10.5%. Since inception, it's done 14.2%. So fairly good returns so far. I want to look at the historical index itself and look at the 5-year trailing just to give us an idea, and knowing that it's actually tracking the index pretty well. So the 2025 total return target index was 28.1%. If we look at the FTSE developed all cap broad market, that did 22.3%. So my hope is that this will do better. The 5-year volatility annualized was 14.6 on the index, and the broad market was 15.4. Marginal difference there. If we look at the max drawdown, again, this is during bad periods, and because there's quality in there, the drawdown is significantly less than broad market, which is what we would expect. So 23.8% versus 26.1%. If we look at the 5-year CAGR next, this is the target index at 11.2% and the broad market at 11.3%. So again, very marginal difference there on the CAGR. So if we now look at the kind of portfolio role and the strategy of where this fits, it's got massive diversification across developed markets, effortlessly replaces multi-single currency dividend funds, simplifying administration. This is why I included it in both the income pie and the stable growth pie, because I think it has value from that perspective. The growth to value stabilizer, it acts as a risk management counterweight to the concentration of US mega cap tech stocks in standard market cap weighted indexes. And again, this is why I included it in both of the pies. And then the behavior of the finance anchor. So predictable, tangible cash flow every month helps investors maintain strategic discipline during protracted bear markets, preventing you to sell your stocks. So there you go, guys. Hopefully this kind of helps you. It's a good 3-month view, good quarterly review of the fund. It has performed as anticipated. It is distributing as anticipated. So far, it's doing what I'd hoped it to be able to do. It is one personally I am invested in for full transparency, because I think it is a really good fund. And I think probably this type of fund was probably overdue, certainly for the UK and the European markets. Let me know in the comments, guys, whether you're invested in this one. Certainly if you've invested in my pies, you will be. But let me know if this is one you also believe in. Thanks a lot. I will catch you on the next one.